Why do some investors grow wealthy over time while others lose everything? Is the secret hidden in special knowledge, inside tips, or sheer luck? Or could it be that the biggest difference lies not in the market itself, but in how you think? Benjamin Graham, the legendary father of value investing, gives us a surprising answer. Success in investing isn't about predicting the future. It's about controlling yourself. The true danger in the market is not inflation, crashes, or even Wall Street itself. The real enemy is your own emotions. Fear when prices fall and greed when they rise. So what makes an investor intelligent? Graham explains that it's not IQ, talent, or complexity. The intelligent investor is defined by their discipline, patience, and ability to separate speculation from true investing. A genuine investment is one that, after careful study, offers both safety of principle and a reasonable return. Everything else, no matter how exciting, falls into speculation. This distinction matters because when you gamble under the illusion of investing, you expose yourself to devastating mistakes. But when you approach the market with Graham's mindset, you're no longer at the mercy of hype, headlines, or crowd panic. You're guided by a rational framework designed to protect you first and grow your wealth second. In short, Graham's timeless lesson is this. The intelligent investor isn't chasing quick wins. Their power lies in consistency, clarity, and character. Do you really know what kind of investor you are? Are you playing it safe without realizing it? Or taking risks disguised as smart moves? Could your entire financial future depend on answering this one question correctly? Benjamin Graham believed that before you buy a single stock or bond, you must define yourself as either a defensive investor or an enterprising investor. Why? Because your identity shapes every choice you make in the market. The defensive investor is someone who values peace of mind above all. They don't chase trends, they don't obsess over stock charts, and they don't try to outsmart Wall Street. Instead, they follow a disciplined formula. Spread investments between reliable bonds and strong, established companies. Graham often suggested a balance, 50% stocks and 50% bonds, adjusting slightly depending on market conditions. The reward? Stability, steady returns, and protection from life's financial storms. But what if you crave more than safety? Then you might be the enterprising investor. This path demands dedication. Studying financial statements, searching for undervalued companies, and staying alert for opportunities the crowd has missed. Yet Graham warns, it's not about gambling on hot stocks or chasing rumors. True enterprise is about patience, discipline, and rational analysis. Done right, it can deliver higher returns. Done wrong, it can ruin you. So here's the real challenge. Which path suits your temperament? Graham's brilliance lies in showing that either choice can lead to success, if you're honest about who you are. Is it possible to consistently outsmart the stock market? Can the average investor really find hidden opportunities that Wall Street's brightest minds have overlooked? Or is trying to beat the market nothing more than a dangerous illusion? Benjamin Graham addresses this head-on. Most investors will never consistently beat the market, and that's okay. The real goal isn't to defeat the market, but to build a strategy that protects your wealth and grows it steadily over time. Chasing hot tips and market predictions is usually just another form of speculation, not intelligent investing. So how does Graham suggest approaching this challenge? He offers two paths. The defensive investor accepts average market returns by buying high-quality, diversified assets, stocks of strong companies, and secure bonds. This approach might sound modest, but history proves it's effective. Over time, simply avoiding big mistakes often leads to better results than chasing risky gains. For the enterprising investor, however, the question isn't about beating the market in the flashy sense. It's about seeking undervalued opportunities that others ignore. This requires patience, rigorous analysis, and emotional control. But even then, Graham warns, success is not guaranteed. The market can remain irrational longer than you can remain confident. The truth is liberating. You don't need to beat the market to become wealthy. You only need a disciplined plan that shields you from the traps of greed and fear. In fact, Graham argues humility and patience are far more profitable than arrogance and overconfidence. What if the stock market wasn't a battlefield of numbers, but a person whispering in your ear every day. What if this person was sometimes wildly optimistic, other times deeply depressed? Should you trust him, fear him, or ignore him? Benjamin Graham introduces one of his most famous ideas, Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day he comes to you with an offer. He'll either buy your share or sell you his. But here's the catch, his mood swings wildly. Some days he's euphoric and quotes you sky-high prices. Other days he's gloomy and practically gives his share away. Now here's the lesson. You don't have to follow Mr. Market's emotions. His job is to serve you, not guide you. If his offer is attractive, take it. If it's absurd, simply ignore him. Intelligent investors treat the market the same way. They buy when prices are favorable, and they resist selling just because panic sets in. This metaphor reveals a critical truth. The stock market isn't always rational. Prices often swing far above or below a company's true value. That's where opportunity lies, not in predicting every fluctuation, but in patiently waiting for times when Mr. Market's mood works in your favor. In the end, Graham's Mr. Market reminds us of this. The market is not your master. It's your servant. The intelligent investor wins by staying calm when others lose control. When you buy a stock, are you just buying a number on a screen? Is its price the same as its value? Or could there be a hidden truth beneath the surface? And if so, how can you tell when something is truly cheap or dangerously overpriced? Benjamin Graham teaches us one of the most powerful concepts in investing: intrinsic value. A company's real worth doesn't come from its daily stock price. It comes from its underlying business, its earnings, assets, dividends, and growth potential. The market may swing prices wildly, but the company's true value changes much more slowly. So how do you protect yourself as an investor? By insisting on a margin of safety. This means never paying full price for a stock's calculated value. Instead, you demand a discount, buying only when the stock trades well below its intrinsic worth. This margin cushions you against mistakes in judgment, unexpected downturns, or the unpredictable nature of the market. For example, if analysis suggests a company is worth $100 per share, an intelligent investor might only buy if it falls to $70. That way, even if they miscalculated or the economy shifts, they still have a protective buffer. This principle flips the script on speculation. Instead of guessing where prices might go tomorrow, you anchor your decisions in the reality of what a business is truly worth today. Graham's timeless insight is this: price is what you pay, but value is what you get. What separates the winners from the losers? Is it spotting trends before they explode? Is it luck, timing, or secret formulas? Or is there something far simpler, yet far more powerful, that defines the intelligent investor? Benjamin Graham leaves us with a profound truth. Being an intelligent investor is not about beating others. It's about mastering yourself. The market will always swing between optimism and despair, offering temptations and fears at every corner. But your success depends on resisting those emotional traps. The intelligent investor commits to a strategy, whether defensive or enterprising, and sticks to it with discipline. They focus on protecting their money first, demanding a margin of safety, and treating every stock not as a lottery ticket but as part of a real business. They don't let Mr. Market's mood dictate their decisions. Instead, they use his irrationality to their advantage. And here's the final insight. Investing is not about getting rich quick. Graham shows us that wealth comes through patience, rationality, and consistency. Even average investors, by avoiding big mistakes and staying steady, can outperform speculators who chase the latest craze. In the end, the intelligence in investing is not measured in IQ points, but in character. It's the courage to think independently, the discipline to avoid greed and fear, and the wisdom to value long-term growth over short-term thrills.